ETFs 101, a Main Street guide to getting started. Invest in 2026. The gap between everyday Americans on Main Street and the wealthy on Wall Street isn't just about income. It's about access to financial knowledge and specific tools. Many people feel locked out of investing, paralyzed by jargon, confusion, and fear. Hi, everyone. I'm Marcus Sturdivant Sr., and I believe financial clarity should be available to everyone. That's why I focus on bridging that gap, providing clear, actionable financial information. Today, we're cutting through the noise that stops so many people from taking their first steps. This video isn't just about day trading or some risky overnight strategy. Wrong video. You can click and go on if that's what you're looking for. This is about building a solid, resilient foundation for your future. Starting today in 2026. Using one of the most effective and beginner-friendly tools available. Exchange traded funds, or ETFs. By the end of this video, you'll know what you need to open an account, precisely what to buy, and how to set yourself up for a long-term financial success and avoid hidden taxes and fees. Quick disclaimer, this is not personalized financial advice, as you need to consult a professional or another professional, as everyone's situation is different. This is a beginner's guide to get you started, get your ETFs, and just getting started in investing. So the information presented in this video is for educational, informational purposes only, and is not personalized financial advice. Your situation is unique, so please consult with a qualified financial advisor who understands your specific goals and risk tolerance. That'll help in the why. We'll cover the why later. All right. Let's empower you to get your money working for you. First thing, financial literacy, the safety guards and market context. Before we even think about executing a trade or buying a stock or ETF, we need essential guardrails in place. I call this measure twice, cut once, personal rule of finance. You need a safety net. First, your emergency fund. This is absolutely non-negotiable. You should have at least 3 to 6 months of essential living expenses. I'm talking about rent, mortgage, groceries, utilities, transportation, saved up in a separate, easily accessible high-yield savings account. If you're married and you work at the same place, or you're married and you have one earner in the family, you will want to have 6 to 12 months of emergency funds built up available in cash in a high-yield savings account. As your risk is higher if one person was to lose their job if you both work at the same place, or as it's much higher if you only have one earner and that person loses a job as well. So single people or people who are married with dual incomes from different places, 3 to 6 months. If you are married and you work at the same place, or you're married and have a single income, you want 6 to 12 months of emergency savings saved up. That's the first part of blocking and tackling, right? Second, your high interest debt. If you're currently carrying high interest debts, I'm talking 18 to 20%, in credit card fees or loans, it's costing you a fortune every month. Especially if you're not paying it off. That's what I mean by carrying debt. You're not paying your balance down to zero every month. Paying off that is a guaranteed return on investment. Some would say a better return than stocks, or any stock bet that you can make. Prioritizing paying down that bad debt before aggressively investing in the long term. To contextualize, if you're paying 20% in credit cards, the stock market in the last 3 years has done about 25, 23, and 17% respectively in returns. So that's a little framing for it. Third, maybe most importantly of all, mindset. Stock market can and is volatile, choppy, turbulent, fickle, sometimes angry, sometimes happy, sometimes jubilant. It's a very temperamental instrument. Just look at 2025. The S&P had a fantastic run from April through the end of the year, gained a total of over 16% for the year, rewarding long-term investors. But I don't know if you remember about this time last year, or early from February to April, it got real rocky. We saw some turbulence in the market. We saw as the market was being economically detoxed, which we're still in the process of, global tensions, tariffs, geopolitical situations, all those type of things play into the volatility. And we just saw a shaky start, which is a perfect reminder that markets don't go up in a straight line. Trees don't grow to a straight line either. So remember that. Investing is a marathon, not a sprint. We're aiming for long-term compounding growth, generally over 5 year or more horizon, right? If you need this money in the next 12 months for a down payment on a wedding or a down payment on your house, you're not investing in stocks, not all of it in stocks. That's not an appropriate place for those type of funds. If you have your kids' college fund that you've had in the 529, you probably want to change the allocations in there. But what we're talking about is we're building wealth slowly, deliberately, and smartly. Understanding that short-term volatility is normal. Getting started. Yeah, right, let's go. The items you need. Okay, we got the safety net in place. We got our mindset right. Now what do you actually need to start buying things? It's surprisingly simple in today's digital world. An online brokerage account. This is an after-tax account, so you will pay taxes on any gains. But think of this as a special bank account designed specifically for buying and holding stocks and funds. It's your personal investment platform. Great news here in 2026 is that most major brokers have abolished account fee minimums and offer truly commission-free trades for most ETFs and stocks. You literally don't pay them a fee every time you click buy or sell these specific funds. The funds themselves may have a fee, so that's something to check. We'll cover fees later. Some of my top recommendations for beginners, just based on the recommendations and ease of use. Personally, me and my firm, we use Altruist for our custodian, which is just a firm that holds your money. That's what you call the custodian of the brokerage account. But Fidelity, Vanguard, Charles Schwab, these are all also custodians. They're reliable, easy to navigate, and have fantastic educational resources for new investors. If you're looking at a local bank, Bank of America has teams up with Merrill Lynch, so that would be another type of place where you can look at it as well. Setting up one of these takes about 10 minutes. You'll need a social security number and your regular bank account details to link a transfer. Once your account is open, you link your regular checking account and transfer the specific money you plan to invest. Remember, money you don't need for the next 3, 5, 10 years. And then basic terms, right? So let's just quickly define the essentials you need to navigate this system. A stock. A stock is a tiny ownership in a specific company. ETF, exchange traded fund. A diversified basket that holds many stocks or other assets all at once. Mutual fund. Another type of investment basket, but with different rules and potential drawbacks we'll discuss next. 2 steps down. So step 3, ETFs versus mutual funds. The right tool and tax chips. So we're not talking about individual stocks. That's a deeper conversation. So we have 2 main types of investment baskets for this conversation. ETFs and mutual funds. Which one should you use as a beginner on Main Street? Hint, most 401ks or retirement funds for your workplace are set up in mutual funds. For everyday investors starting out, though, I strongly recommend ETFs. And here are some of the key reasons why they usually beat mutual funds. I mentioned the big F word earlier, fees, expense ratios. If you see that, that's fees, same thing. ETFs are typically passively managed, meaning that they just track an index. They have lower fees, often costing just a few dollars a year for tracking, let's say $10,000 you have invested. Mutual funds are often actively managed by a team trying to beat the market, which is expensive, and those higher fees eat directly into your returns. Trading flexibility. You can buy ETFs at any time of the day. They usually trade at the same time stocks trade. But with mutual funds are only priced and traded once a day after the market closes. So usually around 4:30 every day, your mutual fund will trade. based on the price of that trade at the day. So if you saw a movement in an area inside of a mutual fund or specific stock, you could trade it your ETF at that time, but you couldn't in the mutual fund. Minimums. Many mutual funds require a larger initial investment, sometimes $1,000 or more. You can start buying most ETFs with a single share or even a fractional share from anywhere $10, $20 to $50. And here's here's a big one that trips up most people and costs them real money. Just the consequence. In mutual funds, the fund managers often buy and sell stocks within the fund throughout the year and to adjust their strategy. When they sell for a profit, this may require capital gains to be distributed to you or in some type of taxable action. Even if other people inside those funds selling for gains, you can be hit with a tax bill. This means you can get the surprise tax bill, like I said, in December on your gains, even if the total value of your fund went down that year, even if you didn't sell anything yourself. This is a huge unnecessary value detractor. ETFs are structured much more tax efficiently, meaning you generally only realize and pay taxes when you personally decide to sell the funds for a profit down the line. And in this case, that's years down the line. For building wealth simply, efficiently, and tax smartly, ETFs are the winner for the everyday investor, beginning investor. We're keeping it simple, Sam. All right, so buying ETFs, simple diversified options, right? So you sell on ETFs, why again? Diversification. We're going with diversification. If you buy a stock in just one company, you risk everything on that single company performance. An ETF lets you own thousands of companies all at once. That's what you call single stock concentration risk. Sometimes that works out for you. Think of ExxonMobil, and I'm not recommending any stocks, once again, just giving some examples. ExxonMobil over the last, I believe maybe 90 years, has compared to the S&P 500, has outperformed by a lot. But once again, there are just certain stocks that work the way, but you would have to be a stock picker. You'd have to know to stay inside that stock. You'd have to have the mindset not to sell because it was not a straight shot up and to the right for ExxonMobil. All right, I digress. Here are two fantastic type of funds that are perfect for beginners, very first purchase. So let's talk about funds that track the top U.S. 500s, the S&P 500 as they call it. It's the 500 largest U.S. companies, publicly traded in the United States. When you buy this, you literally own a piece of every American industry and company. It's the health of the American economy and one smart investment. You can find these in any brokerage. Option 2, a total world stock ETF. This goes even bigger. It owns over 9,000 stocks from across the entire globe, US, Europe, Asia, and everywhere. This is true global diversification and a truly hands-off approach to global growth. There are also ETFs that focus specifically on investing internationally outside the US. There are ETFs that focus on different capitalizations, market caps. So there are ones that focus on mid cap and small cap, smaller companies and larger companies. It just depends on where you want to invest, but beginning, just a simple S&P 500 ETF or total world ETF would be a good option to begin with. So how you buy them right away? Don't try to time the market. Guessing when the price is lowest, that's stressful and usually unsuccessful. Some do it. You usually hear about their wins, right? But most fail at that. Instead, how about using dollar cost averaging? This is for a long-term investment. Automate your investments. Set up an automatic transfer of, $20, $50, $100 or whatever you can afford every week, bi-weekly, monthly, into one of these ETFs. When the market is down, your money buys more shares. When the market is up, it buys fewer shares. Over time, this strategy smooths out the market volatility and builds a much more solid discipline in your investment. because you're continuously investing and you're not getting trapped by ups and downs in the market, highs and lows. Tune out the noise. Focus on growth if you're going to invest individually. Long-term strategy and automation. Let's make it simple. We set up the what and the how. Now for the when. Once you set up your automated investments, you need to resist the urge to check that stock price every single day. The market goes up and down daily. Volatility is normal. Volatility is actually healthy. Some volatility, the reasons for volatility depend, but some volatility is always healthy. Our focus is purely long-term growth. That's why I say we're looking through the noise and past the noise. Just think, if you started investing last year, 2025, by the end of 2025, you were up 16%. If you checked your portfolio in January, February, or March and didn't do, even beginning of April and didn't do anything, or if you made a drastic move, you could have really hurt your returns, hurt your retirement, hurt your investments. So long-term investments. So review your portfolio, maybe in situations like the beginning of last year, maybe a couple times a month. But in general, you might just want to review it, a few times a year probably. This type of investment. Just make sure your goals haven't changed drastically. If you have a major life event, you buy a home, or you have a child, or you get married, or you get divorced, or anything like that, major life event, you change jobs, then you probably want to take a look at what you have, where you have it. Okay? And then there's also, you can pay a professional, which can go from a robo-advisor on one of these websites I mentioned, or you can hire a financial professional like myself. And those ranges vary. Some do it for fees, some do it based on different metrics. But the key takeaway here, folks, is that time in the market is significantly more important than trying to time the market. All right. Conclusion, some actionable steps that we can take care of. Some stuff we can do. First of all, starting to invest is a pivotal moment in your financial journey. It's the moment you just stop saving money and start putting money to work for you. I applaud that. Leveraging the power of capitalism to build your family's future. To add value, beyond this video, I'm going to put some information, some links that you can check out in the description. But here are 3 actionable steps you can take today. First, verify your emergency fund. Make sure those guardrails are in place today. These are things you need to do before you go open your brokerage account and buy any stocks. Make sure you have those funds set in place. Some may ask, why would you set up an emergency fund before you pay off credit card debt? What I've seen is, if a person pays off their credit card debt without a proper emergency fund, and one of those life events happens, a person who's generally in the habit of having a higher credit card level that we've been working on paying off will use that credit card to pay for that emergency, and then you're right back in the same cycle. So we want to have that emergency fund set up. We do want to still make payments towards the high interest debt. If you have to choose between debts first, go for the higher interest debt is generally a good idea. But there are varying views on that. So step 1, emergency fund. All right. You also need a budget, but that's another video. If y'all want me to make a video on budgeting, just drop it in the comments. Let me know. I actually wrote an article on that. Choose a brokerage account. Step 2, choose a brokerage account. Like I said, I work with, my firm works with Altruist as our custodian. But you have Schwab, you have Fidelity, you have Vanguard. There's just a lot of different places that you can reach out to set up this brokerage account. Remember, the brokerage account is a taxable account, so any gains that you make, that you sell, you will pay taxes on. But on the other side, if you have losses, you can harvest tax losses. But that's beyond the depth of this video. We're 50,000 feet. All right. And then automate a small transfer. That's step 3. Buy your first diversified ETF this week. So I gave you a lot of information here, but I want to hear from you. Let me know when you open that account. Why have you opened it? What's holding you back? Drop a comment below. Engagement helps this channel grow to reach to more people like you, people on Main Street, people who are just seeking financial literacy, financial education. So comment, share, engage. And if you found this video helpful, please like it, subscribe to my channel for more Main Street to Wall Street advice, and hit the notification bell. You can find me on LinkedIn, Marcus Sturdivant Sr. You can find my firm, abcsquared.com. That's our website. And once again, this is a disclaimer that I'm Marcus Sturdivant. This is not personalized financial advice for anyone. It's just what I hope is a great educational tool for people who just want to get started with investing and don't know where to begin. So I appreciate you. Keep watching. Keep investing in yourself. I'll see you in the next video. Let me know if there's any topics you want me to talk about that I haven't discussed. And peace.